$1,572. That's what this trade made in 6 trading days, on a stock that dropped almost $70 from entry to exit. Dell fell off a cliff the day after this cash-secured put was opened, briefly touching an intraday low of $368. The strike was $385. Do the math. This position was underwater on paper. So how did it close green? That's exactly what we're unpacking today. On July 14th, AMOL sold to open one contract of the Dell August 7th $385 put for $25.58 per share. One contract is 100 shares, so total premium collected was $2,558. That cash hits the account immediately. The capital at risk, the cash set aside to potentially buy 100 shares at $385, was $38,500. The break-even on this position was $359.42. That's the $385 strike minus the $25.58 premium received. Below that level, the position would start accumulating real losses dollar for dollar. Max gain was capped at the full $2,558 premium, achievable if Dell stayed above $385 by August 7th. The return on capital at risk, 4.1% in under 2 weeks. The chart tells a wild story. Entry at $456.79 on July 14th, right near the 30-day resistance of $469. Then a violent 2-day drop, $412 on the 15th, $390 on the 16th, and an intraday low of $368.15 on the 17th. That's below the $385 strike. The stock then clawed back, $381 on the 20th, $404 on the 21st, and a strong recovery to $441.80 on July 22nd, when the position was closed. That V-shaped recovery from the lows is the whole ball game here. After the close on July 22nd, Dell pulled back again. By July 28th, the stock was sitting at $392.10, just $7 above the $385 strike. If this position had been held open, that renewed pressure would have been nerve-wracking all over again. Closing at 61% of max profit on the recovery rally was the disciplined move. The post-close price action confirms it. The exit captured the peak of the rebound. Waiting for full expiration would have meant another week of white-knuckle risk. Here's the honest lesson from this trade. The cash-secured put structure did exactly what it's supposed to do, but most people would have exited it at the wrong time. When Dell broke below $385 on July 17th and the intraday low hit $368, the emotional pressure to buy back the put and cut the loss was real. The loss alert fired. The instinct is to protect yourself. But look at the numbers. The break-even was $359.42. The stock never got there. The structure of the trade, the premium buffer built into a cash-secured put, absorbed the volatility. This is why strike selection matters more than anything else in cash-secured put trading. Selling the $385 put when the stock was at $456 gave nearly 15% of downside cushion. If you had sold a closer strike, say $430, this trade would have been a genuine loss. The second lesson, closing at 61% of max profit after 8 calendar days, is not leaving money on the table. It's risk management. The position achieved its goal. The stock was already showing signs of another leg lower by the 28th. Taking the gain when the trade is working is a skill, not a weakness. High volatility gives you premium. High volatility also means the stock can move against you hard and fast. Respect both sides of that equation. That's the sensible trade for this week. If you want the full scorecard on this position, strikes, Greeks, the works, head over to thesensibletrader.com. Follow us on Twitter for daily trade breakdowns and market insights. And remember, every trade teaches you something, even the ones that make you sweat.